The big talk this morning is definitely the crude prices and the crash that it is witnessing. 20% currently is what it is registering. The Brent as well as NYMEX crude Brent touch around $31 per barrel intraday. But to talk more on this, we are joined by Peter Cardillo, who is Chief Market Economist at Spartan Capital Securities, as well as Seth R. Freeman, who is Senior Managing Director at GlassRatner Advisory Capital Group. Good morning, Seth, as well as Peter. Thank you for joining us on Market Cafe. This is Cheryl on the other side. Peter, I'll come first to you. What do you make of this entire scenario, what's happening in the crude market? Since all our focus was on coronavirus, there you go. OPEC have not agreed to a decision, and Saudi has started an all-out price war.
Yes, well, obviously this is very negative, and of course, we're now in a free fall in terms of the price of oil, and you might even say a free fall in equities as well. And of course, as the price of oil crashes, and the Saudis have basically indicated that they will rise production levels. That means that we're going to have a fighting war within the OPEC members and non.
Did we just lose Peter on the call there? All right, I think we've lost Peter. Seth, are you still with us? Seth, are you still with us?
Yes, can you hear me?
Yes, we can hear you now. Hi. So,
Hi there.
Hi there, good morning. What's your take on this whole situation? Firstly, if you could just briefly give us an overview of what your thoughts regarding the current prices for oil are.
Well, I think one of the concerns was the fact that Saudi sees maybe not a recession, but a slowdown, and they want to maintain market share. And from what I've read, part of what happened is Russia's response, hoping to supposedly get back to the United States because of interfering with the development of their Nord Stream 2 gas pipeline project. And ironically, for India, of course, which is a major net importer of oil, this is a boost for India.
Definitely domestically, we're viewing it as a boost. We just want to understand what impact is also going to have on the global markets, because then India tends to feed off that. So, just another question. If you just look at the current price of oil and you say that the OPEC countries aren't able to come to, a consensus arrangement, do you think that the current futures on oil and what they're kind of projecting for price, some people even have targets for $20 a barrel, do you think that's realistic?
Well, I think we really have to see what happens in the next few days. Oftentimes, the market sellers will overshoot. But this, in combination with the unknown impact of the coronavirus, not only in the U.S., but globally on consumption of oil and gas and so forth, I think we really have to just see how it goes. This can have a very serious impact on the U.S. Oil and gas industry, because fracking is highly productive, but it's more expensive than conventional extraction, and price compression can really hurt U.S. operators, and I understand that was part of Russia's motive.
I believe we have Peter on the phone line with us. Peter, can you hear me? Peter?
Yes, I can hear you.
Yeah, Peter, let's take the conversation forward. And if you see what's the outlook for the global markets now, considering that you earlier had coronavirus scare, now you have crude prices falling, the all-out price war coming in the crude market. And also you have yields, the 10-year U.S. yields that has gone below 0.5%. That's the first time ever. So what's the outlook coming in for the global markets?
Well, let me just begin by saying this: what's happening now is a very serious situation. And when you have oil prices collapsing, that's not good for the global economy, certainly not good for the U.S. economy. And it's quite obvious that the Russians had a political motive attached to this decision not to join the Saudis and the rest of OPEC. And certainly the collapse in yields and the huge sell-off in the equity markets are indicating that we could be headed for a global recession. And the oil situation just complicates that, and it certainly ups the chances of a global recession. What we're seeing now is somewhat the same that we saw back in the financial crisis back in 2008, 2009. So some of that can be attributed to panic selling, but I think the fact that, it was politically motivated by the Russians not to join the OPEC members has not only economic consequences, but geopolitical consequences as well. I'm afraid with the price of oil down to these levels, we could see some serious geopolitical problems erupt in the Gulf area, and that would just add to the turmoil that the global economy is headed for.
And, just one more question. We can get both your take on it one by one. So, where do local investors go today? If you look at oil, it's really receding. Equity markets aren't giving you too many returns. Bond yields are at all-time low. The only thing that really seems to be shining amidst all this is gold. So, for investors, what would your advice be? How would you hedge this whole movement, or where would you look for opportunities?
Well, I would certainly, hold on to my gold positions. And if you get some sort of a dip in gold, I would add to gold. I would not necessarily flee the equity markets, but certainly, you have to stay with positions that can outweigh the chances of recession. So basically, you need to be recession-proof at this time, because I believe what the markets are signaling is recession is not that far away.
And Seth, do you concur with Peter's view on that? And what's your take on where investors should look for opportunities in the current environment?
Well, it again depends on an investor's timeline. And I would certainly agree this isn't a time to dump equities. They've already taken a significant hit. Investors are famous for buying high and selling low, and have a tough time timing their entries and exits. So for long-term investors, this may be a terrible feel like a downward spike, but over the long haul, it's just going to be another razor sawtooth on a long chart. But I actually think that for more adventurous investors, if there are some industries that they believe are overly hit and have the chance of recovery, pricing reflects just incredible selling pressure, that there could be some opportunities if one is adventurous. But I don't know about adding gold necessarily as a hedge, because it could also reverse as well.
And,
this is probably, I would say this is the kind of market, this is maybe the next couple of years, this is the time you may want to be in fixed assets, for example, real estate, that's not so, it's completely disconnected. In fact, it's likely that real estate prices in the U.S. will get a boost because mortgage rates have gone down. And generally that allows prices to rise, and it is increasing demand for mortgage loans and transactions. So in that sense, hard assets may be a good move.
Interesting, because the real estate market here in India, at least in the metropolitan cities, has taken quite a beating, and a lot of these properties are now available at considerable discounts to when the projects were launched. So that might be an interesting insight for our viewers. But just finally coming to you, Peter first, and then Seth, within all this mayhem, do you see any specific opportunities? Like I know here at the channel, we're looking at a couple of aviation stocks quite closely because crude is going to form, the major component of their expenses. So there are a few larger airlines in India which, do represent a compelling opportunity, and they've corrected a lot in price. Would you guys have any preferred picks, whether they be in the US or in emerging markets, or any sectors that you'd like to eye out in the coming 6 to 12 months?
Yeah, I'm not going to signal out any sectors, but I can tell you this, that, markets get overbought and markets get oversold. And, of course, we all know one thing, that good companies are not going to go out of business. And there are a lot of good companies that have, in fact, value companies that have been posting 52 new week lows. And I suspect that that's going to continue for a bit longer. For the long haul, obviously, there could be a lot of good buys out there. But by the same token, you need to be hedged. And the only way you can really hedge yourself in a market like this is by buying a hard asset, and that hard asset happens to be gold. And that's why I suggested that if you get a dip in gold prices, that you should. I believe that individuals should have not 100% portfolio of gold. No, I'm not suggesting that at all. But I am suggesting anywhere from 10 to 15%. So that it becomes a hedge in your portfolio.
Seth and Peter, we leave it at there. Thank you for joining us this morning, giving us a take on the entire crude market crash that's happening, as also on what to do with gold.